Hi, my name is Judith Raneri, and I'm the Senior Portfolio Manager of the Gabelli U.S. Treasury Money Market Fund. Today, I would like to touch briefly on how the Fed minutes to the March FOMC meeting released on April 6th has influenced a move higher in yields and has set the stage for aggressive Fed action for the remainder of 2022. The change in tone and the inflation reality have both gotten more challenging since the Fed minutes to the March FOMC meeting were released. Inflation is now at 8.5% as of March. Geopolitical events continue to add inflation pressures, and continued hawkish comments from Fed officials, which were ratified by the Fed minutes, triggered another leg up in rates, leading the 2-year to break through 2.5% and the 10-year to hit a high of 2.75% for the first time since March of 2019. So let's discuss the hawkish sentiment that came out of the Fed minutes that fueled the volatility seen along the yield curve. The minutes confirmed inflation pressures are persistent, and combined with massive gains in the labor market recovery, tighter monetary policy is a necessity. They pointed to potential rate hikes of 50 basis points at upcoming meetings, and their hawkishness extended to the balance sheet talk as well, stating their strong intention to start rapidly shrinking their $8.9 trillion balance sheet. They agreed that a maximum of $60 billion in treasuries and $35 billion in mortgage-backed securities totaling $95 billion a month would be allowed to roll off, and it would be phased in over 3 months, likely starting in May. While estimates of the impact vary, the tapering process of the balance sheet might have the same effect as an additional quarter-point increase in the short-term rate. This boils down to the market now pricing in a further 225 basis points of interest rate hikes by the end of the year, the most tightening by the Fed since 1994. Given there are 6 scheduled meetings left this year, the current pricing would equate to 3 half-point hikes and 3 quarter-point increases, assuming the Fed rates borrowing costs at every decision. That would lift the upper end of the range to 2 3/4, a level not seen since the 2008 financial crisis. Now, many forecasters no longer see the Fed achieving a soft landing, given this aggressive schedule of tightening. However, there are many that feel raising interest rates and reducing the balance sheet, with the economy still showing signs of momentum, with a strong job market and extra money in consumers' bank accounts, should help the Fed to navigate through this very difficult period of time and avoid a recession. Thank you for watching this episode of Gabelli TV, and please go to www.gabelli.com for more information.
Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.